What's making the news at the Detroit Auto Show? What company is Kroger targeting? And more pain for GE. And then what about all those small cap stocks? All that and much, much more coming up on this episode of Cocktail Investing.
Welcome, one and all, to Cocktail Investing, the podcast where we look to distill all the noise around us. And believe me, there is plenty to be distilled, can't talk today, into clear investing signals. And by we, I mean me, Chris Versace, Tematica Research's chief macro strategist, and...
That's me. I'm the chief macro strategist. Lenore Hawkins, but thanks, Chris, who wants my job.
Why did I say chief macro strategist?
Yes, you did.
Well, you know what? It's just fair game. From time to time, you inherit new titles when you go on TV too. So,
you never know.
Let me rephrase. Me, Chris Versace, Tematica's chief investment officer. Well, now that you say it, and I said it again, I totally hear what you're saying. I totally messed that up. Oh, geez. Oh, man. What are you going to do?
You just want to be me.
Yeah. Well, who doesn't? Well, you know what? If people want to know
so now that everyone knows who the hell we are,
what
the Detroit Auto Show.
Well, actually, what I was going to say is if they're still not sure, where they can find out, right? They can head on over to tematicaresearch.com and take a lot. We got our bio.
So smooth.
I know. So we got all our bios are there. You can see the Monday morning kickoff, the weekly wrap that Lenore and I write. That kind of sets the stage for what you should expect, as well as recap the key global macro events of the week. And then there's past editions of the podcast, premium products, all that good stuff. Again, all at tematicaresearch.com. So take a visit. And, if you could also, I almost forgot, check us out on iTunes. You could, rate the podcast, give us some feedback. We'd love it all. Just trying to make the podcast bigger and better for you, the listener. So like you said, Lenore, let's talk about the Detroit Auto Show. Last week was all about CES 2018. We dedicated the last podcast to it. There's so much news coming out of it. But this week is the Detroit Auto Show. And, I love the auto show. I'm not really a car guy. I think you know that. But I love going there to see what some of the new features are, check out some of the wacky concept cars that, some probably never get built. But there is something fascinating on the news that's coming out of the Detroit Auto Show. And it's just that the big three, which are Fiat Chrysler, Ford, and General Motors, they're all showing up new pickups. I was sitting there and I'm like, pickups? Are pickups really a big thing? But, when you think about how much money these guys make on pickup trucks, it's something like $10,000 a vehicle. You can see why they want to, pivot towards having a more robust offering of pickups and trying to get as much pickup market share as they could. But it's just fascinating to me. I mean, how many people do you know who drive a pickup that actually use that rig for work?
Well, they use it, just not for a job necessarily, but
Right. I mean, I could see, you're hauling furniture.
Got someplace to put it all.
Oh, yeah. Or if you're hauling furniture or doing different things like that. I mean, I know people who have pickups, but it's very few of them are like, professional contractors or something like that, where they're hauling a lot of tools. So it's just kind of funny. And, there's some data out from cargurus.com, and they say only about a quarter of pickup owners these days are using the rig for work. And then they turned around, and I love this. I just think this is really funny. It says, for others, it's become like the four-wheeled equivalent of a cowboy hat. And I just thought to myself, that is one expensive cowboy hat. I think the joke is falling flat. I could be wrong. On this. but if it is for argument's sake an expensive cowboy hat, it makes me wonder: is this kind of a thing that's, the shift towards pickup trucks, if it's happening? Is this, moving a little bit into our affordable luxury lifestyle as people are, quote unquote, trying to live the life? I'm not sure, but it is something to watch, I think.
Well, I think we more see the demand moving back and forth based on the oil prices. And while oil prices have been rising, they're still well below where they were a couple of years ago.
Well, do you think then that if someone is able to come out with an electric vehicle pickup truck, that might facilitate some buying? Or you think it's too early yet?
Well, I think it depends on what market you're looking at. If you're talking North Dakota, I don't think so. The batteries aren't going to work so well there. And it's not like you've got a cute little charging station, every 50 miles or so.
So the next time I'm in North Dakota and I see your face on the back of one of those milk cartons, I'll know why. All right. Anyway, moving along, just in terms of some other, things catching our radar. Kroger, grocery chain Kroger, which has been battling the combination of Amazon, Whole Foods, as well as, Costco and others moving into grocery, particularly fresh grocery. Kroger is apparently sniffing around our old friend, Box.com. You remember those guys?
Yep.
Yeah, I mean, that was an interesting, Box is an interesting company because, when we talked with the CEO on the podcast, it's got to be 6-7 months ago, something like that.
Yeah.
Yeah, I mean, I thought it was fascinating because to me, it was Costco meets our connected society investing theme in a big, big way, where they're not limited by shelf space. And they were, and I liked them too because they figured out not only 2-day shipping, but they like to have a lot of fun with what they're doing. And there's always little snacks in those big pink boxes that you get.
This is very true.
All right. And then the last thing, just catching our eye before we shift over and talk about small cap stocks, General Electric, GE, once again taking on the chin. This company, I got to tell you, over the last 6 months, it has been nothing but pain for this company. And the new management team's already considering a number of different strategic reviews. And then now today, the news is out that they're considering breaking apart the American Icon after it disclosed even more problems with one of its major units. And that one is, of course, GE Capital. Now, I remember, I don't know if it was 5-10 years ago, Lenore, or maybe more, GE Capital, could do no wrong.
Oh, that was more than 10 years ago. Yeah, back when it was the icon of how you run a business. That was pre-financial crisis. They got their little heinies handed to them because their credit division, it was an interesting play because they were financing a lot of their own sales. The GE credit division was allowing people to buy GE products, so it was seller financing, and then that all came to a crashing end.
Isn't there a term for that in Washington known as self-dealing?
A little bit.
Well, anyway, so we'll see what happens with GE, but it is just fascinating how, what was once considered, one of the best run companies is all of a sudden just a minefield of problems. And it's fascinating as an investor to see how things can turn. But, at some point, maybe at the right share price, who knows, maybe GE becomes interesting again. But from my perspective, as I just see all these problems bubbling up, it's very easy to say, stay away.
What's a lot more interesting to me was to see what happened with Kodak. All they had to do was toss out their blockchain and their stock price went up 200%, which was just freaking awesome. Well, and Kodak is now going to have a digital currency.
And then the idea is that you'll use that digital currency to pay for photo services, right?
Yeah, it's all about licensing, but it is just astounding. They're talking about it, so they just talk about it, and boom.
It's
just like in the later 90s, you just added .com and boom, your valuation went up.
Yeah. Well, I mean, who's the other one? Overstock.com. There was some news or some chatter, I guess, not company specific news, but or company issued news that they might just get rid of the core business and focus on cryptocurrencies, and the stock exploded. Unbelievable.
Well, it is. I mean, the whole cryptocurrency thing. It is. The blockchain technology is going to change every aspect, I think, of the global economy in ways we can't even fathom. And I think it's going to be more impactful than even the internet was.
Okay, hang on. Mark this time, everybody. January 16th, 2018, 12:56 p.m. Eastern. Lenore Hawkins calls it on blockchain.
I don't think I'm not really, that's not terribly profound. I mean, that's kind of like saying the sun comes up in the east. I mean, I think that's, you look at all the different companies that are hopping on and figuring out that they have to have a blockchain solution. And it's a very different dynamic than we've seen in the past with technology, where the technology kind of leads the demand, where you don't realize you need it and you see all this new technology, like, oh, how do I hop on that? Now you've got people saying, hey, business, where is your blockchain solution?
Yes. Well, I mean, over the holiday weekend, I was a little surprised. I had to re-up my Microsoft licenses for Office. and I could pay by credit card, debit card, PayPal, or Bitcoin. And to me, that was just like, like an eye opener to it.
Yeah, it's the more I learn about it, the more fascinated I am. But yes, we are in a little bit of a bubble there. But it's not like the bubble we're seeing in stocks. So
no.
as we're talking about stocks, how about we do? You want to talk a little bit about small cap? I think.
Yeah, let's talk about small caps because there's a wide variety of stocks, and everything from mega cap stocks, large cap stocks, small cap stocks, micro cap stocks, and some people have an affinity for very liquid names. Other people like to find these undiscovered gems, and I just wanted to spend a little bit of time talking about small cap stocks. They can offer opportunity, they can offer risk. They fit very well with some of our investment strategies, whether it's buy the bullets, not the guns, or some other things. And I just wanted to spend a little bit of time today talking about them and kind of putting forth the notion that there's opportunity. And I think that perhaps if you can find the right one, it can make an interesting addition to your portfolio, particularly if you find the right thematically positioned one. So with that, let's indeed talk about small cap stocks. And just for the uninitiated, what is market cap? I mean, it's very simple. It's a shorthand for market capitalization, which is just the share price times the number of shares outstanding. So, okay, some sandbox math, as we'd like to call it, but the right way to think about it is it's really the market value of a company's outstanding shares. And, when we talk about market caps, they tend to fall into about, 5 categories or so. So there's mega cap, companies that have a market cap of 200 billion and greater. Now, they are the largest of the large, the cream of the cream, as if it were, of publicly traded companies. So, here we're talking size like Apple, Amazon, Alphabet, very large, very liquid, very well covered from a equity research perspective, tons of news flow. I mean, my God, I don't think I can log on to my RSS reader and not see 4 or 5 news stories about Apple, not in the same day, but in the same, several hours. So the second one is what they call big or large cap stocks. These tend to be stock market capitalizations between 10 and 200 billion. So there tend to be companies that have been, quote unquote, around the block, relatively more mature, stable, and secure. Then we drift down to mid cap stocks. These are 2 billion to 10 billion. And these tend to be a little more volatile, a little more growthy in nature. And then we sift down to small cap stocks, which are between 300 million in market cap to 2 billion. And these, again, they may not be the most seasoned companies. They can be, but more often than not, you're going to see your more newly public companies in here. For example, we've got a couple of companies that are going to be going public later this year. And I think the ones that I'm eyeing, Lenore, tell me what you think. Spotify and Dropbox, they're probably not going to be small cap stocks. They're probably going to be more like mid cap stocks, don't you think?
Well, in today's market, Jesus, they may come out as large cap.
True.
Crazy valuations we're seeing.
Right. So small cap stocks too, they may not have the most lengthy track records. They may not have been around for decades like some of the large cap companies, but they are growing and viable businesses. And we'll talk about them more in a few minutes. And then there's micro cap stocks. These are the companies whose market caps are between 50 and 300 million. And I could just say that, with great risk, I sound like Spider-Man, comes great reward in that, these tend to be smaller companies, some, as we'll talk about in a few minutes, thinly traded, and that can cause all sorts of other issues you want to keep your hands on, and eyes and ears. So just generally speaking, to review the market caps, here are some rules of thumbs. The larger the market cap, the greater the trading volume. And that's important. You want to be able to get into a position and get out of a position.
Yeah. And that means, that trading volume, what that means is that when you want to get in or out, you're not going to have a massive impact on the share price. If you have something that has a very, very low trading volume and you want to buy, say, 1,000 shares, the fact that you came in and wanted to buy 1,000 shares can have a big impact. If you're talking about a mega cap like an Apple, selling a couple 100,000 shares is going to have zero. When the only thing that matters with trading volume to remember is to think about how much of it you could be buying and selling and what the average trading volume is of that, and just see, okay, is am I going to have an impact on the price of this?
Am I going to disrupt the price of it? Yeah, exactly right. Exactly right. There's also tends to be better information the larger the company, Lenore, right?
Yeah, well, there's more people, the more trading volume, that means more shares are being traded. That means more people are looking at it, more people are interested. It also means it's more difficult to get an edge on anybody because there's so many people looking at it. And that's the reason the small caps, there can be, theoretically, there can be more opportunity with them because there's just fewer people looking at them.
Absolutely, absolutely, and we'll talk about that in a minute. But when we take a look at small caps, at the end of the day, whether it's small cap, large cap, mid cap, from our perspective, we have to continue to see if there is a viable thematic tailwind pushing the company's business along. Remember, we think sector investing is dead. We're going to look at our 17 investment themes and try and understand what is benefiting the core business that is powering earnings that will drive shares. That's the key of it all. So let's take an example of one small cap stock. It's a company, Lenore, that you have probably visited. You've probably shopped there. It's Barnes and Noble, ticker symbol BKS. And I don't think there's any shocking revelation when we say that Barnes and Noble is probably having a very difficult time along with brick and mortar retail and as Amazon continues to expand its footprint. Wouldn't you say?
Yeah, I don't remember the last time I've been in a Barnes and Noble.
I could remember the last time up until recently that I could find a Barnes and Noble. How about that?
I bet you could actually ask a lot of people about Barnes and Noble and they think, isn't it gone already?
Well, up not too far outside of the Washington, D.C. area there, Barnes & Noble is actually flirting with a new concept with this rather large cafe, and they still sell books and everything else. And, it's a great place, a lot of light, a lot of Wi-Fi power, a lot of power cables and cords and stuff like that. So great if you want to go in. But I visited it a number of times during the holiday shopping season and even after. And I just don't see the conversion there between people going in, getting a cup of coffee, sitting around, checking their email, doing some things, and meandering over to the other side and buying a book.
Yeah, they're facing the same problem that most all retail is facing, where the push now, because you don't need to go to retail shopping for the I need to gets. The I need to gets you can usually get a lot easier and probably at a better price just by looking online. So this is more of the I want to go experience something, and the shopping has evolved more into something that an enjoyable shopping experience rather than dealing with crowds and aisles of clothes and all that. And I think Barnes and Noble is definitely trying to create more of an experiential thing, but how's that going to translate into actually selling things? Doesn't look like it so far.
Well, especially since I can walk right down the aisle with my iPhone, pull up the Amazon app and showroom and have the book delivered, in some instances the same day. I don't have to carry it.
Well, they're facing some similar problems that like GoPro, which you and I have been talking about forever, that we've never really thought GoPro's not a company. GoPro is a product. And GoPro has realized that, and I think GoPro shareholders have realized that yes, this is a product. This is not a company.
Right, and so just skipping back to Barnes and Noble for a second, and I think this kind of hammers it home. They recently shared that their holiday sales for the 9-week holiday period ending December 30th. I mean, they were bad, Lenore. I mean, not only were total sales down about 6.4%, comparable same-store sales down also 6.4%. Here's the thing. Barnes & Noble's online sales fell 4.5% year over year. Now, everybody is shifting towards digital shopping, like we said. We saw this in the December retail sales report when the numbers were up huge, 12.7% year over year for the month of December, 11% for the last 3 months of the year. And they're falling by 4.5%. This sounds to me like a company that is hitting a huge thematic headwind, and the management team is scrambling and they don't know what to do.
Absolutely.
All right. I mean, I'm just calling it like I see it.
Yeah, done. Like I see it. Absolutely done.
Yeah. So, again, you want to make sure that whatever the cap is on the company, when we talk about market cap, make sure there is a pronounced thematic tailwind behind it. You don't want to get trapped with a headwind. It's not where you want to be. And just again, to touch on trading volume, there's an expression that we used to use. It's called, Roach Motel stocks. And if you remember that old Roach Motel commercial, roaches get in, but they don't get out. Like Laura was saying earlier, you want to make sure that you can get in a stock. It's not thinly traded. And while you're buying and selling, you're not going to see any disruption to the share price. And Lenore, I think we've talked about it in on prior podcasts and other writings, but I think our personal preference is to see something like at least average daily trading volume of around about 100,000 shares, right?
For an average retail investor, you want to have a decent amount.
Right, absolutely. So the other thing to check on when you're looking at companies is information and news flow. The smaller in cap you go, the lot harder it can be to find information on companies. There's still the SEC filings and all that other stuff, but you need to find the materials that you need to do the homework. Okay, and we could sit here and go on and on about the homework, Lenore, but I do think that we've kind of already done that, right? In a little volume known as Cocktail Investing, the book, we lay out what you need to look for in the homework. And I know as I'm saying this, there's going to be a lot of this, homework. But you've got to do the homework to understand what it is you're buying. Okay. And if you go to Cocktail Investing, the book, chapter 10 lays out the 12 questions you need to answer when you're going to buy a stock. That's page 224 for those looking. And then to help identify sources for all the data that you'll need, you go back to the appendix, and I think it's pages 300, 321, something like that. And hat tip to Lenore, because she was the one who said, we really have got to help people understand where they can find this stuff. And I just looked at it as more pages to write. But you know what? She was absolutely right. So Lenore, let me ask you this question now that we just kind of did some of that basic building block stuff. Why do we like small cap stocks?
Well, it's usually more opportunity with them. When you've got the big cap, like we said before, when you have the larger cap stocks, the reason that they're so big is there's so much demand for them. There's so many people following them. There's so many people invested in them. So most of what can be known about them is already out there, and you're competing with a hell of a lot of people to try and find something where you have an edge, something, or you see something that others don't see. Because successful investing means you find value that is underappreciated, right? It's not about, right now we're in a momentum market where it's just, get in because things are going up, but that's not investing. That's gambling. Real investing is you find a company that the market currently doesn't get why it should be worth more, and you buy it when it's worth less than it ought to be. And then you just wait as the market figures it out. It's a lot easier to do that with smaller companies that not as many people are following. So, for example, one of the companies.
Go ahead. Oh, yeah. One of the ones, is USA Technologies, ticker symbol USAT. It's on the thematic investing select list, and it's been for some time. It's part of our cashless consumption theme. And when most people tend to think about cashless consumption, they think about credit cards. They tend to think almost immediately about payment processing network companies, Visa, MasterCard, American Express, and so on. But what we're seeing with the push towards mobile payments is a lot of opportunity in, believe it or not, vending machines. And USA Technologies was one of the first companies that enabled vending machines to take credit cards, and now they're doing it again with mobile payments. So you think about being, yesterday I was down at the Capital One Arena seeing the Washington Wizards play. They lost. Don't need to go into more about it than that. It was a close game, but they lost. And along the vending machines there, you can pay with your phone, and that's courtesy of, and I looked this up, the ePort technology, which is owned by USA Technologies. So, it's fascinating that you can start to see some of these under-recognized companies. If you look around for them, you can see signs that their business is growing and the technology is being deployed. And people, let me tell you, people were using them because they didn't want to wait in the lines for the concession stands. So it's really, really pretty cool when you stumble across these. And I think I first came across USA Technologies when they were like a $2 stock. And this is going back a couple of years. And today they're trading over $9. So, as long as the confirming data points are there, you can kind of ride these thematic tailwinds to greater and greater profits. So that's one that's, not really recognized. As we've been saying, there's not always a lot of information out there, again, which is the opportunity. You really have to roll up and dig into the financial filings to understand the businesses. And, if you want, you might also be able to think about talking to the investor relations officers at these companies who will answer questions. Just give them a ring. The other thing we like about these small cap stocks is that they could be an avenue for companies to pivot larger companies, I should say, to pivot their business models, whether that makes them take out candidates or strategic partners or whatever you want. And Lenore, I know you like chocolate. I love my chocolate too, but we know that like a company like Hershey, it's, the candy sales are not what they once were, Lenore. And that's because sugar has become almost like public enemy number one. And this is leading Hershey to kind of pivot its business a little bit. They took out a small cap company, Amplify Snacks, the maker of Skinny Pop, as part of their need to transform their business. And they're doing this. This is the second or third small nip and tuck acquisition that Hershey is doing. So small cap stocks, there is that potential takeout avenue. Doesn't always have to happen, but it is another reason, if you can find the right one, it can make small cap stocks kind of interesting. And then, Lenore, the strategy, you talked about this on our last podcast, was buy the bullets, not the guns.
There's a company that kind of fits into that. It's AXT Inc., which is a supplier of substrates that are building blocks for RF and other connectivity semiconductors. And we talked about that on last week's podcast. It was, we see a growing number of such devices coming out of the Consumer Electronics Show. And that's before 5G even explodes with the Internet of Things. So as we see demand for this type of devices pick up, companies like Skyworks, Broadcom,
and others,
AXT, they're likely to see a pickup in that demand for substrate.
Right. So that kind of ties in with buy the bullets, not the guns. And I think the key takeaway is there could be a lot of opportunity in small cap stocks. Do your homework, find the right thematically positioned ones, make sure that there's ample trading volume, and do the homework. Anything else on small cap stocks, Lenore?
I think we got it.
All right. Now let's segue into the market, because I know last week we like we said, we did a lot of deep diving on CES 2018. So we were a little light on market commentary. So why don't you take us away and tell us what's going on?
Actually, I think one of the things that's been really interesting in the market is just kind of looking at the momentum that is kind of unprecedented level, at least within this recovery. And then on the other end, it's interest rates. Mm-hmm. What we're seeing there is the U.S. 10-year has hit the highest level we've seen since 2014. And that's happening because a lot of these central banks are really shifting their policies. Now, the Bank of Japan didn't announce anything, but last week we saw that there was a slowing in their pace of monthly bond purchases under its quantitative easing program. So they didn't come out and say they were going to do anything, but when we saw what their bond purchases looked like, things had changed. Now there was rumors that China may be switching as well. Now China's saying that they aren't. Who knows? But those rumors did actually affect the market, where people were believing that China was cutting back its purchase of treasuries. For technical reasons, I don't really think that's actually possible given how foreign exchange reserves work, but the rumor mattered. Then we also saw on Thursday, the European Central Bank minutes were a lot more hawkish than was expected. And out of that, with the more hawkish tone, the euro actually spiked to a 3-year high against the dollar.
Now, let me ask you, are you surprised at a more hawkish tone? Because you've been talking about the European economy really heating up over the last several months.
It's getting a lot stronger. It's the European economy has actually been stronger relatively than the US. And on top of that, we're seeing their currency be strong, that's impressive, because having your economy growing and while your currency is appreciating materially against one of your biggest trading partners, that's not an easy thing to do. The US, we're benefiting. Like, we keep hearing all this, the US economy is so great, so strong. If you look at what the dollar's done and you look at how much of our economy we benefit from the exports, it's a different story. We also have a more hawkish Fed. Even just last week, Larry Summers, now he's not part of the Fed, but he pointed out that the Fed typically cuts rates around 5% during a recession. Except for right now, the Fed funds rate is 1.5%. How do you cut 5% with a 1.5% rate, right? So that's going to be a little tough. So you can see where the Fed is really eager to get some arrows back in its quiver, which is one of the things that I think is really raising that Fed fund rate, because we don't have a whole lot of evidence of high inflation. The bottom line here is that the central bank accommodation has been really the biggest story for markets for years. That's really what's helping to boost asset prices, and it's as simple as this. You had massive buying by central banks of certain kinds of assets. So if they're buying them, then you and I can't buy them, right? So then if we were going to buy them, now we can't buy them. Well, we got to go buy something else.
So let me just make sure I understand this, and the listeners do too. So what I'm hearing in this changing tune, for the longest time, people were wondering, when are bankers likely to take the training wheels off and let the economy stand on its own? And it sounds like we're maybe a lot closer than we've ever been, at least in the last 10 years.
We're getting there. But to keep that in context, just last year in 2017, the biggest economies, the G4 central banks, actually purchased 170 billion more government debt than was issued. That means we actually had a contraction in the supply of government debt. Now that's reversing. And if you think about that, like in normal times, that government debt, right? Because governments issue debt because they all pretty much spend more than they take in. Right. So, and in normal times, that debt goes out into the world and, we buy it. You and I buy it. Pension funds buy it. But you couldn't buy it. There was actually less issued. There's less out there than was issued. You couldn't buy it because all the governments were buying it up. Well, that's changing now. They're not going to buy so much. So that means that the big buyer has stepped out, and that affects all asset prices. And on top of that, we have expectations that the US is going to have to issue even more debt because we're already running a really hefty deficit. Our deficit right now is much, much bigger than one would expect, because normally when the economy is doing great, you're not supposed to have big, huge deficits. You have those big, huge deficits when the economy is just, totally tanked and the government steps in to spend. And that's the idea is that gets the economy back on its feet with the government spending. Well, the government is spending right now like we're in a debt, like we are in a recession. And with tax cuts, and this isn't, I love tax cuts, big fan of keeping more money. But the problem is those tax cuts mean that there's going to be even less money going to the government. And we have reason to believe that the increase in income generation that one would normally expect is probably going to be muted based on where we are in the business cycle. So all that means that you're going to see bigger deficit. And if you have bigger deficits from the US, that just means more debt out there. So if you're going to have more debt out there, and if you're going to have less buying by central banks of the debt that's out there, then what do? You increase supply and you reduce demand. And that means an impact on prices, right? If you increase supply and you reduce demand. So if we think about that, I'm hearing, I always try to put this in terms of individuals, right? The person. So you're telling me that the person, in this case, the United States, is going to be running up even greater deficits, taking on more debt, which normally would make them, an individual risky. Yep.
Which means that, other countries in this case may not be willing to buy as much. Yeah,
that would be true if we were an
individual, right?
And it would also be true if we weren't the global reserve currency. That changes everything. We're the biggest economy. We're still the biggest economy in the world. We're the global reserve currency. Everything gets traded in dollars, so it changes the demand for treasuries. But you do have we're seeing a lot of upward pressure on yields, right? Because as prices go down, as for bonds, as the price goes down, the yield, the interest rate on it goes up. So now, why do you even care about this? And everybody's talking about the 10-year. Well, really, when you look at nominal GDP, that's basically the growth of an economy plus inflation, right? That's your nominal GDP number. Now, the 10-year Treasury usually reflects expectations for growth in the economy. That's usually real GDP. Now, if you go all the way back to 1962, the average spread between the 10-year Treasury and real GDP has been about 0.31%. And the two of them move pretty closely together. So you look at the 10-year, it's sort of a proxy for GDP. Except for right now, nominal GDP is 1.82% higher than the 10-year rate, roughly. I mean, interest rates are changing on a daily basis, but roughly like that, right? So why do we have this big disparity? Well, interest rates have been forced artificially low because you had this massive demand from governments, from the US government, from other governments buying a sovereign debt. So with all that extra demand, because remember, if prices go up, yields go down. So all that extra demand drove the price of bonds up, which meant that the yields were pressed even lower. Now, we also can see that while that relationship between GDP and the 10-year has been, fairly consistent, since 2010, the 10-year rate has been way below GDP. Well, that's what I'm talking about. That's quantitative easing. That's been this artificial effect. Now, if the central banks, not banks, but central banks, if they're going to step away from this, if they're going to not be buying so much bonds, then that means that interest rates can start to come up and we can get more of a normal relationship between the 10-year and across the world, the 10-year and actual growth rates.
Okay.
So that's the whole thing about if we're looking at interest rates. Now, the other thing that I've been finding kind of interesting is, we keep talking about how valuations have been so extreme, and we've been saying that for a while, and they have been. Valuations have been extreme, and that's kind of becoming a really boring story to talk about.
Well, is it? Hang on. Let me just interject on this one. So we had said that in the fourth quarter, I think from mid-October on, the S&P was trading north of 20 times earnings expectations, yada yada yada. And now we're at the point, really from December of 2017, and even now, the whole view is increasingly on the forward look, which is 2018, and we're starting to see people readjust their earnings expectations for the S&P higher due to the benefit of tax cuts. And we're seeing companies from FedEx and a whole bunch of others come out and saying, it's looking more and more like this, meaning higher earnings expectations. And I think, don't hold me to this, but I want to say the S&P is trading, 16, 17 times, I think, forward earnings now?
Forward, it's like 18.
I think that's old numbers before those tax cuts were factored in.
Well, okay, then we also got to talk about who's making the assumptions, because this is assumptions. I mean,
I totally agree with you on that.
The reality is you can't ignore where we are today when looking forward. And the fact is that the market rallied about over 20% last year, but after we get the final numbers for Q4, earnings growth is going to be less than half that pace. So this was not an earnings rally, right? This was a multiple expansion. This was driven mostly by multiple expansion. If we look at since the second round of quantitative easing began, the market has averaged about 12% gains a year. Now that's double the historical norms, and it's also about twice what we've seen the growth in operating EPS. Right? So again, that's a multiple expansion. Now today, the S&P 500 is just over 2.1 times sales. That's just below the peak of 2000. Now, the market's only been in this area about 4%, at these kinds of valuations, about 4% of the time. And on top of that, if you look at the median stock, look at their trailing and their forward. Again, we've only been in this heady territory 1% of the time. If we look at price to book, well, that's 3.4 times. We've only been in that kind of territory about 7% of the time. So if you look at those, it just, saying, well, we've only been in this territory, what percent of the time? What that just means is your risk of going up versus the risk of falling, right? When you're in this area that, well, we're rarely ever there, you just got to be aware that there's increasing risk on the downside. On top of that, if you look at the MSCI Momentum Index, and that measures those stocks that are really benefiting from momentum, that rose over 2 times the rate of equity stocks. Now, the last time we saw momentum beating the market by this much was just prior to the Lehman crash in 2008. In addition, you've got the RSI. Now, the RSI is a relative strength index that gauges a 14-day momentum. That's at its fastest level since 1996. So you look at all these things and it's like, okay, we're really, everybody is scared to death of missing out. We've got FOMOs all over the place, the fear of missing out. We have individual investors have put another $21.7 billion into equity tracking ETFs just last week, and another $2.7 billion into stock-based mutual funds.
So I hear all that, and I agree with you that the risk outlook continues to climb. But I guess the question is there anything we can identify that would say, here's the potential catalyst that's going to push the market lower?
You never do know. You never know. I mean, never. The only way we ever really can say, well, that is the catalyst, is in hindsight. Like, who saw that Lehman was going to be the thing?
Oh, absolutely, absolutely.
24 hours before, that was not an issue. I mean, you looked at.
So, are you nervous heading into earnings as earnings season really picks up?
I don't know if earnings is going to do it. I am nervous seeing a market that has accelerated, because you normally, when you see that kind of, when you see a massive acceleration at the upside, like peaks always have this crazy acceleration right at the end. And I'm seeing that. So it's got me nervous. And there's other things that paying attention to, like the U.S. Treasury 2-year yield is for the first time greater than the yield on the S&P 500 in 10 years. We have not seen this situation for 10 years. So the fundamentals of the market dynamics really are changing. You have major buyers stepping out. The central banks are going to be buying less. You have the bond market, the relationship between bonds and stocks is changing. For the first time ever, the 2-year Treasury yield is greater than the yield on the S&P 500. On top of that, now, as we're seeing these interest rates go up, the U.S. economy has roughly about $41 trillion in total debt. These interest rates have been going up, and they've been going up pretty good. And a lot of that debt is short term. Now, as these interest rates go up, it's gonna hurt growth. Now, all the talk about the tax reform, and I love tax cuts again. Like, please, I know I love tax cuts, love them. Big fan of keeping more money in my pocket. But how much is spending really going to improve if you've got interest rates going up and you've got all this debt out there? That means the cost of servicing that debt's going up. Now, is that potentially going to offset I got extra money in my pocket from these tax reforms, but the cost of my credit card debt, my adjustable rate mortgage, all of these things have gone up, and are they going to go up more than the little bit extra I got left over in my pocket?
Yeah, I think
that nobody is looking at that, and that's what's got me nervous.
We talked about that like 3 weeks ago.
Yeah, well, we are. I don't see a whole lot of it.
No, I know. We're not hearing a lot of people talk about it, and the conversation at the time was, and it still is, that the benefits to be had from tax reform are not likely to translate into as robust GDP forecasts as some people are putting out there.
Well, let's look at the reality of households. You've got 2 years ago, the savings rate was 6.1%. A year ago, it was 3.7%, and right now it's 2.9%. So what's really been happening with all this boost in spending, it's just been people are saving less, right? So they got less of a cushion. Now that's just not a sustainable source of growth. And then, okay, the only way you can spend more, right? You spend more because you make more or you borrow more. So, all right, there we go. They're not saving, right? So if we look at the consumer credit balances, well, they rose at a 10.4% annual rate in October. In November, that rate jumped up to a 14.1% annual rate. And if we look, okay, granted, that's around the holiday season, but if you look over the past 4 months, the growth in consumer credit's been at about a 9.3% annual. This is absolute binge territory. So you've got all this borrowing going on. Okay, great. We got tax cuts and more money in your pocket, except for you've just spent all that money that you've already spent it. The extra money that's going to be in your pocket, it's already gotten spent.
Yeah.
Done. So when we look at those credit problems, and again, this is more money in my pocket, except household financial obligation ratio, which is that looks at your monthly debt service and your rental payments, the pain of those versus after-tax income. Now that's hit the highest level in about 6 years. The delinquency rate for auto loans is at the highest level since October of 2011. Right now, we have about $1 trillion in unpaid credit card balances. And that is going to cost, if interest rates don't rise a whole lot more from here, that's going to cost about $50 billion in debt service alone this year. You've got the delinquency rate for all personal loans has reached 2% for the first time since summer of 2013. This has been a credit expansion. So what we've seen in a market that's all about multiple expansion, and we've seen an economy with spending that's all about credit expansion. These are not things that make me comfortable.
When was the last time we saw that? 2006, 7?
Yeah, exactly.
Yeah, and we all know how that turned out. I mean, the reality is that the economy, based on what you just described, can only go on for so long. And at some point, there's going to be a little bit of a stress fracture. And, I think a lot of people out there, the herd we'll call them, are seeing tax reform and they're thinking that, this can extend what's happening. And I think what we're saying is it probably cannot.
Yeah, it could already have been spent. The benefit may have already been spent.
Correct. Because, in your litany of statistics over there, the one that you didn't have was the average person doing holiday shopping in December took on another 5 to 6% of credit card debt, which means that, October, November, December, it's just a continued step higher, meaning that they're already saddled with even more debt. And then to your point about interest rates going higher, the amount of money that they will dedicate towards credit card interest payments will be far greater this year than last year. So, all right. Well, let me ask you a couple questions there, Chief Macro Strategist. So we ran through a bunch of credit related statistics, which were great, obviously, but there's other data out there, and we term some of this the hard data and then the soft data. What's your sense as we kind of segue a little, into let's just say the second half of January? How has the data been coming in? Better, worse?
It just hasn't been very robust. It's not been awful. I mean, there's nothing screaming, impending doom, but it hasn't been great. The employment data, it's not bad, but it's been softening. So we're not, the direction of the employment data has been shifting, where rather than continually improving, it's starting to weaken a bit. Durable goods orders and shipments, we saw some weakening there. The non-manufacturing ISM, that was also a big disappointment. We saw a widening of the trade deficit, and the small business survey, the NFIB, which is the National Federation of Independent Businesses, that survey really wasn't all that rosy. That survey, which it was really surprising to see where that had hit a peak in November. In December, there was more concerns, like the number of those small businesses that thought that they were going to build up their inventory or that they were going to pay people more. That was all those things that are really looking forward. They were actually declined, and some of them declined at a level we hadn't, to a degree, like the amount of the decline was really profound. Some of them were the biggest we've ever seen. We also saw retail sales softening. And
I let me just, before we move on to retail sales, I think the NFIB still called out the shortage in skilled workers.
Yeah, but that continues to be an issue. And while we say there's a shortage in skilled workers, at the same time, we're just not seeing wage pressures.
Right.
The real earnings report that we saw last week for about 80% of the population, which is the non-supervisory production employees, that number barely year over year was, less than 1% growth in real income.
So hang on. Let me just,
which is why obviously when wages aren't, for like 80% of the population, when wages haven't gone up, it's no surprise to see that spending is because of lack of savings and increasing debt.
So let me ask you this, because I was listening this morning as I try to do when I'm getting my thoughts together on the day. I tune into Bloomberg Radio, and on that they were talking, about a rising expectation for the Fed, meaning the Fed is more likely than ever to do 3 interest rate hikes, maybe more.
Yeah, you're talking 4.
Right, talking 4. But based on what you just said about that report last week, that's kind of conflicting. So what do you think?
Well, no one ever accused the Fed of
being rational.
Well, yeah, I mean, look at every recession we've had the Fed raise rates into a recession. Right. I mean, our track record, like, forget my opinion. Let's just look at the history. Is the Fed, as the economy weakens, the Fed continues to raise rates because the Fed's always worried about overheating. And this time they've got 2 things. Like, one, being afraid of overheating. Okay. It's hard for me to wrap my head around how anybody could be worried that this economy is overheating. But their real concern, I think, is lack of arrows in the quiver when we do hit a recession, because it's normal. Like, you have booms and busts. It's a normal cycle. We're going to have a recession, and it's every year that passes, it becomes a bit more likely, right? Because inevitably the fall and the winter have to come. They need to have more arrows in the quiver for when that happens to be able to impact, in their mind, they need to be able to do that to impact the economy. Well, with a rate of 1.5%, when you normally in a recession reduce rates by 5%, that's tough. And
it's called break out the surgical scalpel to figure out what you can do.
Well, and look at what's been going on so far. I mean, the Fed raised rates in December, and yet what did we see? Well, retail sales increased, 0.35% month over month. That was the softest increase we'd seen since August, and the second weakest since June. But there was a little bit more to that. It's actually, I think it's worse than just 0.35%. If you looked at the components, electronics were down. The sales for electronics down, sales for clothing down, sporting goods, books, hobbies, department stores, all down. What was up, what sales did increase? Grocery stores up by 0.7%, pharmaceuticals up by 0.4%. Well, those are necessities. So yeah, my would like to haves went down, my necessities went up. Then, okay, granted, we did see furniture and building materials, those both increased, except for that's all about recovering from the natural disaster. I mean, good Lord, look at what happened in Texas and in California. You had Florida. People And yeah, they needed new stuff. And yet the market is super giddy and everything is fantastic. So, I'm looking at that going, well, I do not see and keep in mind, looking at those numbers, electronics down, clothing down, sporting goods down, department stores down, and yet credit card debt went up.
Yeah.
So what are they? Because they're using credit cards to buy food at the grocery store. Like, let's look into the details here, people.
Well, I mean, look, if people have, if they're living paycheck to paycheck, they've got to pay some way.
Well, you've got year over year that real income, real earnings didn't grow by even 1%. So where's all the spending going to come from? When we see these spending numbers, and if I see spending numbers continually grossly outpacing how much people are earning, how much that's improving, I get nervous.
I totally hear you, but just stepping back with my thematic hat on, I think that's great for Costco. I think it's great for Amazon.
Absolutely. No, there's areas that it's good for investing. It's just you got to know what the sandbox looks like that you're playing in. And you were asking, do we think the Fed's going to raise rates? Well, CPI isn't exactly on fire. There was a 0.1% month over month headline. Now that wasn't really got all the attention. What got the attention was it was a 0.3 increase in the core. Now that's the highest since January of 2017. But if you looked into the details, there's something a little funky. Auto looked weird. It had new and used cars up by 0.9%. Now that's the highest monthly increase, third highest since 1993. Now that looked really weird because if you look at the PPI, the producer price index for autos, that was only up 0.2%. Something's off here. I don't see how.
Do you think is it possible? And just go back to what you were saying before about the rebuilding and natural disasters coming out of the hurricanes. We know Houston was the fourth largest market. Is it possible that used car prices spiked?
The PPI and the CPI just regardless shouldn't be that far apart. There's something off in the data. So I was looking at it like, for this month, I'm going to strip out the auto. And without that, the core would have been 0.2, which is exactly consensus. And even more important, you look at, we have this overheating economy, right? That the Fed's got to hike rates. Okay, explain to me then, riddle me this. Clothing, down 0.5%. Airfare down 0.5%. Toys down almost 1%. Sporting event prices down 0.5%. Furniture down just shy of 0.5%. And home improvement also down just shy of 0.5%, despite the fact that people are buying more of that as a recovery. So when I see price cutting all over the place, I'm not feeling very inflationary.
I was just going to say, where is the inflation?
Well, tough, and keep in mind too, tough to have a whole lot of inflation when you have a ton of debt.
Yep.
Because debt is like a big, huge anchor around your foot that as soon as you start, swimming, you're trying to move ahead, it starts pulling you down because you have to pay that debt. And as growth expectations go up, interest rates rise. As interest rates rise, the price of that debt goes up. As the price of that debt goes up, the economy starts to slow because it's costing more for you to just keep that same debt load.
It sounds like an anchor is what it sounds like.
Yep.
All right. So I guess that means, Lenore, that we will continue to track the inflation data and all the other data each and every week like we do and be sharing it with listeners. Next week, what do we have on tap? I think the big question, Lenore, when we reconvene next week to do the podcast is, will the government be shut down or not?
It's interesting. Everybody's sort of assuming, don't worry about it. It's going to be, again, we'll have an 11th hour reprieve from this. And it's funny, the things just keep getting more and more polarized. And now you've got the Republicans are just kind of shooting to get another kind of last second kick the can to February 16th. So they're going to kick the can all right, here we go. We're going to cook it like a month.
But, it's funny because I've been hearing and reading that, but we're also starting to hear people go, if it does happen, it's really a question of duration. Is it short? How long is it? What if it continues? So it's almost as if
we've been trained, right? We've been trained because every time that this was a panic, every time the market got all fussy and the sky was falling, somebody swooped in and it just wasn't a big deal anymore. Now, to your point, one of these times it is going to be a big deal.
No. What it is, it's Bugs Bunny all over again. You cross this line, you die. You cross this line, you die. And you do it so many times and nothing happens until finally you actually cross that line and you and something happens. So anyway, so when we reconvene next week for the podcast, we will see if the government shut down. We'll also hear some news, I am sure, from VP Pence's trip abroad. Davos, where the World Economic Forum will be convening. We'll start to hear what's coming out of that. We'll have far more earnings, and I believe we might actually be on location somewhere next week.
Yep. Chris and I are going to be at the Inside ETF conference in Florida.
That's right. We'll have all sorts of stuff going on when it regards to ETFs, tying in our thematics, and we'll be talking about the usual, I don't want to say, what's the technical term, Lenore? Gobbledygook that we talk about every week?
Incredibly brilliant insight and analysis.
So
that's I think what you meant.
I think that is what I meant. So with that, we will bid adieu, and we will see you next week.
Have a great week.